Okay, for today, we're going to cover chapters 13 and 14. There's a lot more information in 13 than there is in 14, but we can dispense with both of them at the same time. And this will be the basis for your quiz next week. So, chapter 13 deals with saving, investment, and the financial system. So, let's talk about that. All right, one of the main things is we have to understand savings in the economy and its role in economics. Savings is a double-edged sword to the economy. If, for instance, we save and don't spend in the short run, we are hurting the economy. However, by saving, we're accumulating wealth over time, and that represents the possibility of future investment in technology, etc. So that's why we consider it to be a double-edged sword. If it's short run, it hurts the economy. Long run, it's possibly a benefit to the economy. It becomes, instead of being consumption, it becomes investment. So let's talk about that. C, consumption. The biggest part of the GDP formula for the US is consumption. As we said, it's 70% of the number for gross domestic product. So we look at that and we say, all right, so we don't spend in the short run. Therefore, when we don't go to the store and buy goods and services that companies will turn around and produce more of, we are hurting the economy in the short run. Again, now we're only talking about the short run. And as a result, it provides a drag on the economy. Now, these statistics on consumption is something that economists look at every single quarter and every single month. And what happens to consumption is very important to what is going to happen in the economy in the short run. And of course, that affects the stock market. IG, however, gross investment, we save for the future to make investments. And if we save, we create wealth. And that wealth can be a future investment and help the economy in the long run. So the other side of the coin is if we don't save for future investment, it can have a negative effect. So here's the thing. We spend it today and it's good. We save it today and it's not so good. But if we forget the short run and talk about the long run, it represents potential investment in the economy, which is a good thing. Investment, however, is only about 13%, but it has a lot of impact in providing jobs for people in the economy, and as a result, it has a big impact on consumption in the economy. So remember, as we've talked about before, disposable income can only be saved or consumed. And when we talk about disposable income, we don't mean the salary or the end of the quarterly, monthly, weekly, or hourly wage you collect. It's the amount of money that goes into your checking account. So after we deduct the FICA tax and any retirement money or anything else you put aside, it becomes disposable income and it can only be consumed or saved. Again, we're not going to take the money we receive and burn it. Okay, next, business entities. When we talk about business, there are several different types of entities that are involved in business. There's probably three main ones, but anyway, let's cover what we mean by business entities. First one is a sole proprietorship. Now, this is your mom and pop operation, usually the local donut shop or dry cleaners. These are usually small businesses. They're owned by individuals and they're operated as an individual business. For reporting taxes, a sole proprietorship has to file a separate part of his return, which shows the profit or loss from his sole proprietorship, and he's taxed on that income. Interesting enough, in the US, the biggest employers, we think about McDonald's. Well, again, that's franchise, so that's an individual. That could be a sole proprietorship. But we think about employers as being the big companies like GE, General Motors, Chrysler, Ford, etc. But really, if you took all the small businesses and put them all together, they are really the ones that hire people. So it's important that we support that group or that organization or that group of entrepreneurs. Next, we have a partnership. Partnerships or a limited liability partnership has become popular these days. Now, a business partnership is it's owned by one or more, it's owned by more than one person, and each person shares in the profits or losses of the business operations. Let's split that up a little bit. Let's talk about, first of all, a traditional partnership. A traditional partnership is like two people. They form a partnership and they go into business together. It could be an accounting firm, it could be a law firm, it could be just about anything. There are some disadvantages to that type of partnership in that if one of the partner dies, then the partnership ceases to exist, and or the partner's spouse becomes the partner of the other partner. That sounds confusing, but anyway, you know what I mean. So as an organization, as an entity, that's not good. So a lot of people have come up with an alternative, which is called a limited liability partnership. And that enables them to provide, let's say, insurance, for instance. We may want to buy an insurance policy on each partner, in that if one dies or decides to leave the partnership, the surviving spouse or whoever receives a significant amount of money, and therefore they are bought out of the partnership, and the partnership can continue to operate with the one person who was the other partner. So partnerships can take several forms. There's lots of different variations in these partnerships, but basically the intent is to try to avoid the situation where if one of the partners dies, the partnership ceases to exist, and or your partner becomes your partner's spouse. Then there's a corporation, and there are lots of forms of corporations. The larger corporations, for the most part, are called sub-S corporations. The sub-S corporations will be the listed stock exchange corporations like General Electric, General Motors, Johnson & Johnson, the drug firms, etc. So a sub-S is, generally speaking, the larger corporations listed on stock exchanges and are the big operators. There's also under a corporation an LLC, a limited liability corporation, much like the partnership, in that you don't have as much in terms of reporting requirements as you do in a C corporation. It operates kind of like a partnership, but the money is distributed to the owners. The other variation of the partnership corporation is a sub-S. This is pretty popular with small businesses that want the benefits of incorporation and at the same time want to be incorporated and don't have the partnership issues. So a sub-S is a small corporation. At the end of the year, the taxes are filed and each partner gets a statement that says how much money he's responsible for paying taxes on. So the total profits of the corporation, the sub-S, go to the individuals who are the shareholders of that corporation. So each year they have to pay tax on the income from the sub-S corporation. I forget offhand the form that's filed, but I used to have one myself when I was in the real estate business. Okay, so a little bit further on. Corporations are formed in which their headquarters resides. For instance, you can incorporate in the state of California, do business in California. Incorporate in Texas to do business in Texas. And of course, if there's state income tax, you have to pay taxes in that particular state. Other problem with or issue with sub-S corporations and corporations is that you have to file in the state, and it costs money to do that filing. Sometimes it depends on the state, but sometimes the fees can be significant. If you want to do business in multiple states, you have to file in those states as well. But basically, your headquarters is where your taxing authority is where your headquarters reside. So how do we own stock? we own a certificate of ownership. That's called a stock certificate. It's issued to owners and or to investors. Now, a stock certificate is very important because it conveys ownership. It's a certificate of ownership, but it conveys no liability to the investor owner, which means that if you have a share of stock in a corporation and they do something stupid, violate the law, don't pay their income taxes, you cannot be held responsible for their problems or for their mistakes or for their legal gyrations. So it's a certificate of ownership, but again, you have no liability as an owner. Let's talk about the stock market. Stock market terms. I think I brought in on Monday, I brought in and showed you the candle system and how you read a stock table. Those particular elements are part of every stock, depending on how you have the stock chart issued to you and what makes it easiest to understand. But it's a very informative method or a very informative way of figuring out what's happened in the marketplace. So, stock market terms. First of all, NYSE. NYSE stands for the New York Stock Exchange. It is the oldest, and most of the large companies are traded here. For instance, GE, General Motors, Ford, IBM, etc. These are the big guys. They're traded here. It's very expensive to be a member of this exchange, so you've got to be a pretty substantial corporation. Most of the symbols for stocks listed on the New York Stock Exchange are either a single letter or two letters, or maximum usually three letters. For instance, IBM is IBM, GE is GE, General Motors is GM. So if there's a conflict in initials, they usually go to one or two more digits. So that's how it's done on the New York Stock Exchange. Again, that's the oldest and largest, and it costs a lot of money to be listed on the New York Stock Exchange. But the volume and the interest is there. NASDAQ. NASDAQ is an older, or not as old exchange. It's newer, as a matter of fact. It grew out of the old over-the-counter market, which was a market in which people just traded stocks and you traded through a brokerage or you could trade directly. So NASDAQ exchange is an exchange that's the source for mostly the tech firms because it grew out of startups. A lot of the tech firms are on the NASDAQ exchange. IPO startups, tech firms are pretty much listed on the New York Stock Exchange. For instance, Apple. Apple is on the I'm sorry, not New York, but the NASDAQ exchange, and NASDAQ stands for National Association of Security Dealers. New York Stock Exchange is different. NASDAQ was, again, one of the first firms to be involved in smaller companies that were too small to be listed on the New York Stock Exchange. So NASDAQ grew out of the old system of trading stocks between companies and between firms on small companies. One of the most significant things that NASDAQ accomplished was it became the exchange that was the first to go electronic. In other words, you could buy and sell by trading stocks either by phone call or by, as it has turned out, the internet. The other unique thing about it is most of the stocks traded on the NASDAQ are four-digit numbers, the letters. Apple, for instance, is AAPL, and Apple is still on the next NASDAQ exchange. CBOE, this is Chicago Board of Options and Commodity Trading Market. This market is a little bit different in that it originally came to be as a result of trading in things like commodities, pork bellies, sheep, goats, wheat, etc. It originally was a complete, for the most part, a trading market, and it was located in Chicago. NYSE is in New York, the NASDAQ is in New York, the CBOE is in Chicago. And it's now become the home of a lot of the option trading. We're going to talk about what options are and how you can buy options on stocks. But it's, for the most part, option and commodity trading exchange, and it's located physically in Chicago. All right, now Dow Jones Industrial Average. That page out of the Wall Street Journal I showed you had the Dow Jones Industrial Average. And what it is, it's an index, okay, of the 30 largest listed companies on the exchange, on any exchange, NASDAQ or NYSE. For instance, Apple is in there, IBM is in there, GE is in there. I'm not sure whether GM is in there anymore, but pretty much the 30 largest listed companies are part of what they call the Dow Jones Industrial Average, or DJIA. The S&P 500 is another average, and it's an index of the 500 largest companies listed on either NASDAQ or the NYSE. So it would include the 30 industrials up above, but it also includes additional companies that what these indexes are trying to do is get a cross section of what the economy or what the business environment in a particular country looks like. And a lot of people use different things. A lot of people prefer just the Dow Jones Industrial Average. Some use the S&P 500. The Russell 2000 is another index or listing or group of stocks that are of a mid-size or smaller nature. So it's 2,000 small and medium-sized capitalized listed stocks. In other words, you may have stocks listed on Dow Jones Industrial Average on the billions, but the Russell may have stocks listed in the millions. Okay, and then I showed you the daily trading, the candle handle, or some call it a handle, others call it a candle. If it's green, it's traded positive during the day and closed positive. If it's red, it closed negative during the day in trading. All right, a little bit more detail on the stock exchanges. New York Stock Exchange, known as the Big Board. It's located on 11 Wall Street. It's in the middle of New York Financial District. If you get a chance to ever go down to New York, go down to the south end where Wall Street's located, and you'll see that bull that Merrill Lynch uses as their logo. It's huge, and it's on in a square in the street in Wall Street, and it's in the financial district. If you do get a chance to go down there, you're not too far from the old former fish market area, which has become a boutique area for restaurants and people to go to look at. So there's things to do down there. You can go down there and look, and then go over to the seaport, they call it, and it's restaurants. It's right on the Hudson River. Helicopters fly out of there for giving tours. The other part is it's not too far from the scene of the World Trade Center. And if you ever get a chance to go in there, go see that memorial. The memorial is outstanding. It's got, in granite, in black granite, it's got the name card of everybody who lost their life on 9/11, either at the Pentagon or at the Twin Towers or Flight 93 that crashed in Pennsylvania. It's awesome to see. All right, the largest stock exchange in the world by capitalization and number of companies, $16.6 trillion as of May 2013. So New York Stock Exchange is the largest in the world. Thing to remember, it's located on Wall Street and it's called the Big Board. Average daily volume is $169 billion. That's a lot of money. All right, NASDAQ, National Association of Security Dealers, Automated Quotations. And this is an interesting stock exchange, by the way. In terms of market share and trading volume, it's the largest stock exchange now in the US. And it has the distinction of being the first electronic stock market founded in 1971. And its quoting system was different than what the NYSE was using at the time. New York Stock Exchange had a quotation system that was in eighths. In other words, a stock, let's say it was a $20 stock, may have a fractional value of 20 and 1/4, 20 and 1/8, 20 and 1/2, 20 and 3/4, etc. But now with the electronic stock exchange, they went digital. And so with the digits, they were able then to do absolute values. So a stock listed on the NASDAQ exchange became $20.12.5, or $20.25, or $20.50, or $20.75. Instead of using eighths, they went to actual dollar cent numbers. So you can tell the exchange by the way they do it. Now, I'm not sure what the year was, but at some point in time, this was the preferred method of quotations for all investors in the stock market. So as a result, the New York Stock Exchange was forced to trade. Now that cost a lot of people their jobs because the floor of New York Stock Exchange was filled with a lot of people who were called specialists. And the specialist was the one that handled the sales of stock. You put in a bid to sell a stock or to buy a stock, and the specialist was the one that took it on the floor and sold it. Now, because they were using eighths, what they had to do, they could not sell a stock unless they had two trades higher than what they were selling it at. So what they did was they would sell it at, let's say, a quarter, and you would get an eighth. So in the case of the $20 stock, they would sell it at 20 and a quarter, and you would get back 20 and an eighth. And that 20 and a quarter, 20 and an eighth difference was their commission on the trade. That system's gone away now. So first, it was very popular again because it lowered the spread between the bid price and the ask price. Because remember, that spread was always in eighths. So you had to have at least 1/8 separation. And when we went to absolute dollar values in change and coin or in cents, quoting prices in dollars and cents, it eliminated that possibility. And it was unpopular, but in the long run, it prevailed. It's a better way of doing it, period. So NASDAQ, as I said, was formerly the OTC, or the over-the-counter market. And in addition, most of the transactions that went through NASDAQ were handled on the telephone, which again was unique compared to the New York Stock Exchange, because you could not call into the New York Stock Exchange and make a trade. But now with the NASDAQ and the change in New York Stock Exchange, in effect, you do. You go through a broker, he makes the trade for you. Okay. Now, all transactions were handled by phone. With the crash in 1987, then we had a stock market crash in 1987. And it just got overheated. And like a lot of things, the bubble has to burst. So up until that time, trades were handled by phone. After that, all transactions were handled electronically. So it also was the first online trading platform. And this is the way we trade stocks today. You may have an account with TD Ameritrade, for instance, as I do, and you just go online and you make your trades online or on your cell phone. You don't have to make a phone call. You don't have to even be on your computer. You can do it from your cell phone. So it's an online trading platform, and they both now are online trading platforms. And so is the CBOE. Okay, Chicago Board of Options Exchange, located in Chicago, 400 LaSalle Street. And what they list are 2,200 companies, 22 stock indexes, and 140 ETFs. We're going to talk about what ETFs are later on. Now, 2,200 companies. That's a lot. 22 stock indexes and over 140 ETFs. What these are options on these companies. You can buy, for instance, an option on, let's say, IBM, and you think it's going to go up in price, so you buy a 90-day option at a particular price, at today's price. Let's say you're going to buy it at $100 and you expect it to go to 120 in the next 30 days or 90 days, whatever the case may be. So you buy the option on 100 shares, and it's not like you have to buy all the stock at $100. You can buy it for a tenth of the price. The problem is the option expires in 90 days and you could lose whatever you paid for that option. But it's an interesting way to go. Traders use it to hedge. I'll give you, for instance, let's suppose, and you're an analyst on Wall Street, you go to your boss and you say, look, we got to buy IBM. I think it's going to go up. So your boss says, I think you're right. How much do you want to buy? Well, let's buy 10,000 shares. The boss says, ooh, that's a lot of money. And he says, I tell you what we should do, Joe. I tell you what we should do. Let's hedge our bet. So why don't we go over to the Chicago Board of Option Exchange and buy a put on IBM, and let's hedge our bet just in case we're wrong and that stock drops. All right, 2007, the Wall Street Journal estimated the market capitalization for all derivatives, options, swaps, futures, etc., was $450 trillion. That's not billions, that's trillion. And that, of course, includes the stuff that we talked about with the Great Recession. 95% of CBO's orders are traded electronically. And examples of options traded, the S&P 500 index. And the symbol on the CBOE is XPX, SPX, and that is a ETF. You can buy an option on Microsoft, and MSFT on the Chicago Board of Options is the symbol. You can buy option on Standard & Poor's 500, SPY, another one. You can buy an option on gold, a Spider Gold, SPDR. So these are opportunities to play the market in the option area. And again, options have a limited time frame, but you don't pay as much money and you get the same leverage as though you had bought 100 shares. So it's very risky and very speculative. You have to be careful. Don't do it unless you can afford to lose your money. It's highly speculative and it's risky. Again, if you buy, let's say you buy an option for 90 days and you pay, let's say $10. Let's say you pay $300 for the option and the stock is selling at $30. So instead of spending $30,000, you spend $3,000. Now you buy this option and you hang on to it. And if it doesn't go up as you think on a call option, then you will lose all your money. But the other thing that happens to you, the time value of money, as you're holding that option, you can try to sell it off, but the value of what you paid for it, let's say you bought it today, 1 week from today, the value of that option will be less because of the time value of money, unless the price of the stock goes up. It's a very, very speculative and very, very risky business, so you have to be careful. All right, and as I mentioned in the case of the IBM deal, dealers use it to hedge their bets on other investments. They'll cover the downside if they think a stock's going to go up. They'll cover the downside with options. If they think it's going to go down, they'll cover the upside with options. And by the way, those options are put or call. A call option means you think the stock is going to go up. A put option means you think the stock is going to go down. All right, a little bit more on common stocks. And here's what it is. It's a certificate of ownership in a publicly traded company on a listed exchange with voting rights. Now, it's a certificate of ownership, but as I said, the liability is limited. One thing you do have in terms of ability to influence the corporation is you can go either in proxy or in person to their annual meeting and you can cast your votes based on the number of shares you have for managers and executives of the board and the CEO. Again, it has the second bullet here, limited liability. They do something stupid, you are not responsible just because you have a certificate of ownership or a share of stock. Thirdly, increase or decreases in value are primarily based on profit performance. That's what people look for. You'll hear them talk about whether the stocks are going up or down based on the quarterly report of earnings and the quarterly estimate of forecast of future earnings. Now, as we talked about capital gains taxes, again, the gain in value is subject to a capital gains tax at the time of sale. But remember, to be capital gains rate, you have to keep it for more than a year. In addition to that, some stocks pay dividends. GE pays a dividend. Their stock is now down to about $20 a share. I think the yield on their dividends is about 4.8%. You can't get 4.8% anywhere. The problem with GE right now is that people are concerned that as they reduce and try to restructure their spending and get it under control, that they may have to forego paying dividends, and that will impact the stock again. Okay, bankruptcy. You may be not liable for anything, but if the stock goes bankrupt, you will probably lose your entire investment. Take Radio Shack, for instance. You could buy it at $64 a share. At the time they filed bankruptcy, it was 20 cents. So in the case of bankruptcy, common stock shareholders will lose their entire investment. Let's talk about bonds now. A bond is a debt instrument. It's issued by corporations and governments. When we say a debt instrument, what we mean is it's a loan. The company, the government gives you a certificate, and in that certificate, they agree to pay you your money back. They give you a piece of paper, you give them hard cash. Okay? They give you the piece of paper, you take the piece of paper home, and it earns interest. And at some point in time, they pay back in full. So, bonds generally have a face value of about $1,000 per bond. This is pretty much how they structure the bonds. So a bond has a face value of $1,000. It pays interest, and it pays interest for the most part semi-annually for the duration of the bond. When we talk about duration of the bond, we mean how long is it in existence. Most bonds are written for 1 year, they're written for 2 years, written for 10 years, and they're written for 30 years, depending on what the entity prefers to do. So on January 1st, you'll get a check. On July 1st, you'll get a check. The interest is taxed as ordinary income tax rates. All right. So if you're in the 25% tax bracket, you will have to add the interest on any bonds that you own to your income, and you'll have to pay ordinary income taxes on it. Now, municipal bonds are a little bit different. They are exempt from federal taxation. A municipal bond is a bond issued by a local entity, a county, a city, a state, and they're used to provide things like road improvements, road building, new schools, highways, etc. And those bonds pay interest, but they're exempt from taxation at the federal level. Now, that sounds like a great deal, but what happens is the interest rates on municipal bonds are lower than they are on regular bonds. And because they are lower, they're lower because the income tax on them is non-existent. So it's somewhat of a hedge, but you have to be careful. All right. In the event of bankruptcy, the bondholder may not suffer as many or any loss at all as a result of bankruptcy. One of the features of owning a bond is that the corporation has to provide what they call a sinking fund. In other words, if the bond, let's say you have a bond for $1,000, and it's going to mature in 5 years. That means at the end of 5 years, you have to get your $1,000 paid back. So what the corporation does, it sets up a sinking fund of $200 per year. And that way the sinking fund is equal to, and the cash is there, it's equal to what the bond holder is owed. So bond holders are generally in the safest position of all compared to stockholders. All right, then, not to be outdone, the smart guys came up with what was called a preferred stock. A preferred stock is kind of a cross between or a hybrid of a share of common stock and a bond. It does not convey ownership. Okay, you don't have any voting rights with a preferred stock. It is a share of stock. You do have an interest in the corporation in terms of the amount of money that you paid for the preferred stock, but you do not have any ownership nor any voting rights with preferred stock. However, the preferred stock usually pays a dividend. Common stocks don't have to pay a dividend, but preferred stocks do. In order to get people to buy them, they pay pretty significant dividends. It's traded and listed on an exchange, and it can increase or decrease in value. So it's a pretty neat little tool, and it's a lot safer than common stocks. Probably not quite as safe as a bond because preferred stockholders may not have the same kind of leverage or insurance that a bondholder has, but it's certainly got a better relationship than it would have if you had a share of stock. Now, for instance, if you have common stock in bankruptcy, the common stockholders' money's gone. Preferred stockholders may have a claim on any money that's left, along with bondholders. So it has a little bit better risk tolerance. Okay, yeah, the reason that corporations do this is because it's an option that if they want to raise money, capital, let's say to expand their facilities, expand their plants, buy more capital equipment, they might prefer to do a preferred stock offering rather than a bond or a common stock. For instance, the common stock would dilute the shareholders that already have the stock. In many cases, if you dilute the stock, you have to turn around and issue existing stockholders what's called a stock dividend to make them whole. So if you need money, this is another way of doing it other than issuing a loan where you have to pay interest, a bond, which is a loan. All right, mutual funds. Mutual fund guys are pretty much the people who manage your long-term investments. Most corporations that offer you, the employee, a 401k, which is a tax-deferred savings account for your retirement, it would be managed primarily by a mutual fund company. Okay, mutual fund companies, I'm sure a lot of you know, in the educational world, TIAA, CREF is a mutual fund company that handles a lot of 401k type or, well, it's not, it's a 401b or something like that. It's a retirement program for teachers, and I think students in some cases can take advantage of it. But there are mutual funds like Fidelity has a series of mutual funds. The company I worked for a while, Waddell & Reed, has mutual funds. They're a mutual fund company. And what these guys do is they manage investments for people for long-term investments. These are not things that you turn over every day, depending on whether the stock market goes up or down. This is a buy and hold type situation. So the value of the mutual fund is determined at the end of every trading day, but it is not traded like a stock. Let me tell you how that works. The mutual fund, let's say mutual fund XYZ, goes out and buys shares of many companies, and it offers you a type of fund. Let's say it's aggressive, which it has a lot of tech companies in it. It offers you the opportunity to buy into that fund at a price, but the price of the fund is not determined until 4 o'clock in the afternoon because all of the stocks underneath it are trading through the day. So there's no way that the mutual fund can tell you what your mutual fund is worth in the middle of the day. They have to wait until 4 o'clock in the afternoon when all the trading is completed. So how do they do this? Well, what they will do is when you join a company, they will have you fill out some forms. And one of the forms will be a risk tolerance form. And what it has in there is a series of questions that you will answer. For instance, if all of your investments, if the market goes down 200 points in a day, would you sell all your investments? What is your age? Age is very important in determining risk tolerance. The older you are, the less risk tolerant you are. You can't afford to lose your money because you haven't got as much time left. So in terms of risk tolerance, the people that buy conservative investments are old folks like myself. The people that buy balanced investments, in other words, part of it is stocks, maybe 60%, 40% of it is bonds. That would be the folks that are your folks' age, the 40s and the 50-year-olds. The young guys starting out, the 30-somethings, what you need to do is look at opportunities to make a lot of money in the stock market. Not only, well, you have to figure out how to lose it, but you have to be able to tolerate a loss and hang on for the long pull. Don't sell it off on a dip, okay? And this is an aggressive portfolio. So all of these questions that you'll answer will help you determine and help the mutual fund company determine how your investments should be laid, or what your proportion of aggressive, conservative, or balanced fund should be. Okay, problem is it costs money. Most of these funds charge 1% to 2% per year in management fees. So a portfolio can cost as much as 1% to 2% a year. In a lot of cases, your company may pay that or pay a portion of it. Now, as I said, portfolios for you as an investor can be aggressive, balanced, conservative, depending primarily on your age. But all of this doesn't have to be totally aggressive, doesn't have to be totally balanced, doesn't have to be totally conservative. They can blend all these features into a portfolio that represents the way you think and your risk tolerance. Beta, we'll talk about that for a minute, but that's basically, does your mutual fund track the S&P 500 index, for instance? That's what beta means. Okay, ETFs. These were invented not too long ago, maybe 20 years ago. ETFs came along because of the shortfalls of mutual funds, the shortcomings of mutual funds. In other words, you couldn't tell what your fund was worth until the end of the day. In addition to that, it cost a lot of money, 1% to 2% commissions. So people invented, Blackstone, for instance, came out with what they called an exchange-traded fund. Now, an ETF takes a listed stock or an index like the S&P 500, and it puts together a group of stocks that mirror exactly what's happening in the, let's say, the S&P 500. So that, let's take gold, for instance. Gold is currently trading for around almost $1,300 a share, an ounce of gold. The gold ETF is trading at $130. So you can buy gold, not have the storage issue, not take advantage of the gold, not have to store it. You can buy an ETF in gold for 10% of the cost of what an ounce of gold would cost you. So it's used as leverage and to get into things at a lower cost and yet have the same benefit. Now, it is a lower cost. For instance, if gold were to go up 5%, that would be 5% on $1,300 per ounce, which is a bigger number than 5% on $130. Okay, so the volume, the percentage increases, the amount being invested is not as significant, but the return is not as significant in absolute dollars either. but it's a great little tool. Now, back to our mutual funds. This thing trades all day long, and you can look it up on your exchange or on your TD Ameritrade account. You can look it up, and the commissions are very, very low. Not at all like the 1 or 2% that mutual funds charge. So one of the reasons for bringing an ETF to the marketplace is primarily it's a heck of a lot cheaper than a mutual fund. Now, a lot of the mutual fund companies are including ETFs in their portfolios. Now, as I just went through it, the index like the S&P 500, it tends to mirror that index. So if the S&P 500 goes up 5%, your ETF tracking the S&P 500 will also go up 5%. But 5% of if the S&P 500 is at 4,000, the 5% on 4,000 a lot bigger than 5% on $400 in terms of absolute dollars of gain. All right, so the benefit of the ETF is the fees are substantially less than the mutual fund. And for instance, you can buy into the Standard & Poor's 500 and track the Standard & Poor's 500, just leave your money there, and it'll function just like a mutual fund that tracks the S&P 500. And the cost will be a lot less, and you'll be able to see what your investment is worth as it trades during the day. So the fees are substantially less than mutual funds, and you can pretty much get the same kind of result. So these ETFs have hurt the mutual fund industry. Okay, chapter 14, basic financial tools. There's not a lot here, so let's kind of go through it quickly. All right, understanding finance, you have to understand the tools. One of the things that's important for you guys is to understand what's going on in the economy so you can manage your own wealth. For instance, is the Federal Reserve increasing interest? Well, that might be a negative. It might cause you to lose money in the stock market. Is the Federal Reserve reducing interest rates? That might be a benefit to the stock market, and stocks might go up. You're not going to be an expert, but you need to be able to read the tea leaves and understand what's going on in the economy. So you need the basic financial tools to understand that. So you have to understand risk and reward in your investment strategies. Don't invest more than you can afford to lose, particularly in a risky investment. Risk and reward investing strategies primarily fit into the spectrum from conservative to balanced to aggressive. I told you what conservative would be. For instance, a conservative investment would be 80% bonds and 20% stocks. A balanced portfolio, for instance, might be 60% stocks and 40% bonds. An aggressive portfolio would be 80% stocks, 20% bonds. So, and again, it's all dependent on your age. The younger you are, the more aggressive you can be. The older you are, the more conservative you have to be to preserve your income. You don't have any time left. Okay, so investment decisions very strongly are age-based. Risk reward, let's talk about that. How much risk are you willing to take for a certain reward? What is your tolerance level for risk? All right. Are you aggressive? Do you want to make a lot of money? Are you willing to take a lot of risks to do it? Are you conservative? Are you content with the interest rate, 2%, 3%, 4%, 5%? Okay. Or are you looking for a 20% return? That's risk versus reward. If, for instance, the stock market would take a big dip like it did in September or 2008, 2009, what will you do? Will you unload everything? Or will you hang on and wait for it to recover? Interesting things happen. At that time, I was involved. I was a certified financial planner. And so I was involved in this whole process. And a lot of people, clients of mine, quite a few, they panicked. They felt that what happened in 2008, 2009, the collapse of the housing market, was going to be another Great Depression. So they pulled all their money out of the stock market. So when the stock market tanked, which went from 13,000, the Dow Jones Industrial Average went from 13,000 down to about 6,000, dropped in half, almost 50%. A lot of people panicked and got out completely. If they'd have stayed in, we not only went past 13,000, we're now up to 23,000. If people would have stayed into the market, they would have recovered all of their money and then some. But panic doesn't help. Okay, so big decision you have to make. Do I sell off or I take my losses or stay and be patient and wait for recovery? The key to long-term investing is patience. One of the things I would tell people, don't bother to look at your investments every day because it's just going to make you crazy. Just leave it alone. Check it every year. Don't worry about it. It's going to be okay. Hard to do though. For instance, I have a nephew. My nephew had some money with me as an investor. But what his take on the whole thing was, he didn't like the idea of just leaving it alone. He's a young guy, very aggressive, as a consultant, very successful. But he just can't stand to leave things alone. So he and I parted ways. He took his money out. We're still good friends. Matter of fact, I'm going up to his house over Thanksgiving. All right. So, as I said, the decision tree is heavily age-based. You have to be patient. One of the things that's key in understanding the growth and income is the beauty of compounding or determining future value. And here's how it works. In year one, you invest $1,000, 5% interest. At the end of the year, you will have $1,050. If you leave it in for another year, year two, you start out with $1,050. 5% interest will yield you $1,102.50. What has happened is you left the money in and it's compounding, which means that you are getting paid interest on interest. Not only on the $1,000 principal, but also on the interest it earned in year one. Carry it on to year three, and you got another 5% on $102.50. And at the end of that year, that's $1,157.62, and so on. Okay, that is how compounding works. So if you don't need the money, put some money away in investment and let compounding help you accumulate wealth. Rule of 70s. This is an interesting one. If you take the interest rates you're going to be paid and you divide it into 70, it will tell you how many years it will take to double your money. For instance, if you're at 5% interest, you did 5 into 70 and you'll find out that it takes you 14 years to double your money. So the higher the return, the quicker you can double your money. And that's called the rule of 70s. It's also, the bankers call it the rule of 7/8. Okay? So use these concepts to think about what you're going to do with your portfolio and your investments and your retirement money. One of the key things I tell students is that if you're smart, you'll take 10% of every dime you make that goes in your checking account and put it away and forget about it. And take advantage of this compounding. Discounted cash flow, present value, is essentially the opposite of compounding. In other words, if you are working for a corporation, the corporation says we want to invest $1 million and we want to build a new factory to build product. Now, what you have to do as a financial analyst is decide what is better for the company's $1 million. Put it in the bank and leave it to earn interest through compounding, or can I make more money by investing in this new facility? So what you do is a forecast, you look at how much it's going to cost you to put the money out there. And instead of using a compounding, you use the inverse of it or the reciprocal of it. So that in the first year, the money you make has to be more than 95% of 100. In other words, 5% is gone. I can use that 5%. I can put it in the bank and earn 5%. So by discounting cash flow using the reciprocal of these things, I can determine if my investment is going to be better than just leaving the money in the bank. So these investment decisions are made all the time by businesses. They want to buy a particular piece of machinery, they want to invest in a new plant, etc. What is my smart option here? Will it generate enough profit to offset what I've lost by not putting that money into a savings account? So if the investment after all expenses and appreciation does not yield a greater profit than putting the money into a savings account with compound interest, then why the heck do it? Okay. Again, these are decisions that corporations make all the time. When I first went to work for the old Burroughs Corporation, which is now Unisys, I was on the corporate financial staff, and this is exactly what I had to do. I had to justify financial investments throughout the company, both in the US and in Europe. Matter of fact, I did the justification for a 100,000 square foot disfile plant in California, in Mission Viejo, California. I did that while I was in Detroit. And several years later, they transferred me out to Detroit to be the controller of that facility. Transferred me from Detroit to Mission Viejo, California to be the controller of that facility. All right, we'll stop there. Your quiz will be based on what we just covered today. And I think it's kind of interesting stuff. If you have questions, please ask in class. And I will see you on Tuesday. Have a good weekend. Bye.